Hi guys, and welcome back to the Mindful Investing channel. Today I want to talk with you about an interesting investment opportunity in the microcap universe called G Group, ticker JOB. G Group is a provider of permanent and temporary staffing solutions in the IT, finance, healthcare and other sectors. Most of G Group's growth in the past stemmed from acquisitions. Unfortunately, they got too greedy and acquired a company with debt at an interest rate of 16% per year. After the acquisition, the debt became a major burden for the company and ate up almost all of its free cash flows. During the COVID pandemic and the associated slowdown in hiring, G Group's cash flows declined and the company got squeezed hard by its debt. That's when they decided to raise equity to get rid of their high-yield debt. Now, G Group trades at a market cap of roughly $60 million with roughly $10 million in net cash. To judge G Group's ability to generate cash flows in context of its current capital structure, we have to adjust their past free cash flows by the interest expenses. When we do so, we see that G Group would have actually been able to achieve nice and constant free cash flows, excluding the COVID years. If we look at fiscal year 2021 or the last 12 months, we see that G Group is currently achieving roughly $10 million in free cash flow. Therefore, G Group currently trades at roughly a 6 times price to free cash flow multiple, and if we exclude its excess cash, it actually trades at roughly 5 times free cash flow. So the valuation on its own already looks like quite an attractive investment. Given G Group's current valuation, management has already discussed doing buybacks. But because they received PPP loans, which have been forgiven by now, they will only be able to do those buybacks starting from December 17th. Instead of buying back shares, management could also decide on using the cash to acquire a new company. Based on a realistic price to free cash flow multiple, they should be able to buy roughly $2 million in new free cash flow with the cash they currently have on their balance sheet. If they do so, they would trade at a price to free cash flow multiple of roughly 5. Also, G Group's CEO has a great track record apart from acquiring a company with high interest rate debt in the staffing industry. Having grown MPS Group mostly through acquisitions and selling the company to Adecco Group for roughly $1.3 billion. The CEO is also invested in the company, even though his stake got also diluted in the process of raising equity to get rid of the debt. But management has already mentioned that they want to increase their stakes, but have not been allowed to yet due to multiple restrictions. Another interesting fact about G Group is their high return on invested capital. Because the business of being a staffing services provider doesn't require much capital, they could also be able to grow their business organically at high rates. Even though G Group seems like an interesting investment, we have to keep in mind the potential risks of such an investment in the current environment. The biggest risk for such an investment currently is probably the risk of a recession. Because if we were to get into a recession right now, spending for such services would probably decrease alongside G Group's cash flows. So that's it for today's video about the microcap G Group. If you have any questions or research you want to share, feel free to do so in the comments. And if you enjoyed the video, feel free to leave a like. As always, please remember to do your own diligence, your own research, and to never simply trust a guy on the internet telling you that there might be a potential investment opportunity. See you next time.